Ladies and gentlemen, good morning, good afternoon, I beg your pardon. That was a great start, wasn't it? My name is Richard Hopkin. I'm Head of Fixed Income here at AFME, and it's my pleasure to welcome you this afternoon to this month's AFME member briefing call. I'm pleased to be joined today by a number of colleagues and also representatives of our member firms to discuss the subject of phasing out IBORs. What does the transition to new risk-free rates mean for the industry? So here with me in the room here at AFME, I have Ian Budge, who's Vice President, UK and Ireland FI Solutions at NatWest Markets, Marcus Mackenzie, who's a partner at Freshfields Brookhouse Derringer, Jessica Wrigley, his colleague, also from Freshfields, myself and my colleagues Anna Back, Alex Hunt, and on the line from Brussels, we have our colleague Debbie Joseph. I think we can turn to the first slide, and just before I kick off on that, the plan is on this call to have the discussion go for about 40 minutes and then leave about 20 minutes for Q&A at the end. And there is, I'm told, a way for you to submit your questions online. We can see the questions as they come up here in the AFME office, and I would very much encourage you all, please, to ask questions because this is all about being interactive. So, turning then to the first slide, why are we all here today talking about this subject? It's fair to say that there is a move away from IBORs across the globe. We have seen significant work on this in the US, in the Eurozone, and in the UK. And in the UK, the work can really be dated back to, it's been going on for quite some time, but I think the last sort of watershed that we had in this discussion was a very important speech made by Andrew Bailey, the Chief Executive of the UK FCA, nearly 1 year ago on the 27th of July last year. I do encourage you all to read his speech. It's not very long. It's about 4 or 5 pages long. If you Google Andrew Bailey FCA LIBOR, you'll find it very, very easily. It's very well worth reading because he explains very clearly the context and the reasons why the FCA, supported by other regulators like the Bank of England and the PRA, are very keen to make this move. So why, in summary, is that? Well, the problem with submissions-based rates like LIBOR and Euribor and others is a number of things. Obviously, everybody remembers the difficulties that LIBOR in particular experienced quite some years ago. Major improvements were made to the governance and production of LIBOR, which addressed that. But even in light of those improvements, the feeling of the FCA was very much that LIBOR and other IBORs didn't do enough to reflect real transactions in the market. There was too much reliance on expert judgment. There were something like 20 banks making submissions. It was getting harder and harder for those banks to make the submissions that they want to do because the number of transactions in the market is relatively small and there's too much reliance on the judgment factor. So the FCA decided to plant a flag in the ground at the end of 2021 and made very clear to the market that at the end of that time, the FCA would not guarantee that it would continue to support LIBOR. That's not the same thing as saying that LIBOR will disappear, but essentially the FCA was very clear that they would no longer require submitting banks to produce LIBOR with effect from the end of that date. They acknowledged that there was a lot of work that the industry had to do to fix that, but they did very much. This was very much, a kind of a call to arms, and I've printed the last sentence from Andrew Bailey's speech here on the slide. Work must begin in earnest on planning transition to alternative reference rates that are based firmly on transactions. the emphasis thereon begin in earnest. That work has started to begin. So, how much work is involved? Well, quite a lot, as you can see from the pie chart. This is drawn from a source that is mentioned also in a very useful reference work produced by EY under the leadership of ISDA and with the support of AFME and other trade associations, the Global IBOR Transition Roadmap, which was published some time ago. And if anybody needs a copy, drop us a line and we can refer to where it is. It's a very good sort of entry-level document if you're new to this subject, which shows the scale of the challenge that's facing us all. And just one of the statistics is laid out here on the pie chart, which is that the notional amount outstanding of products of all kinds, cash and derivatives, referencing IBORs of various kinds, is about $373 trillion. Now that's notional amount outstanding, and some of that is going to roll off before the end of 2021, but it's still a very, very big problem. And if we just turn to the next slide, this gives a little bit more detail of the typical kinds of contracts that are based on IBORs. It's sort of almost like the DNA of the financial system. It's involved in almost everything that financial markets do. So you can see that the derivatives portion is very large, about 80%, and our friends and colleagues at ISDA have been highly engaged in this subject for quite some time before the cash markets. And then 20% sort of cash products. And the types of transactions you would expect to be involved here are all sort of listed down the side here. OTC derivatives, exchange traded derivatives, loans, obviously, both wholesale loans and in some sectors, for example, in the Eurozone, it's not unusual to find Euribor-based mortgages. That's sort of less common here in the UK. We don't have so much in the way of LIBOR-based retail products, but in the Eurozone, there are significant numbers there. Bonds and FRNs, obviously, corporate, and interestingly, this is an interesting discovery for me. I've always thought of government bonds as being exclusively fixed rate, but there are in fact non-trivial amounts of, for example, Italian government bonds that are floating rate and linked in some way to Euribor. So it's an issue that is really, all-pervading. Of course, we've got short-term instruments, repos, we've got securitizations. Securitizations are particularly disproportionately affected by the need to make this move, because, of course, they are predominantly floating rates, LIBOR or Euribor typically. They might have underlying assets that are IBOR-based, and almost inevitably they will have some kind of embedded swap to manage the interest rate risk, with the usual special securitization features. So you've got IBOR issues both in the underlying, in the bond that comes out at the end of the process, and also in the swap that's an important part of the financial engineering in the middle of the transaction. So altogether, we reckon there's about 2.5 trillion euros of bonds and FRNs generally, and 1.2 trillion euros of securitizations that are linked either to GBP, LIBOR, or Euribor in terms of outstandings. So so those in effect are the legacy deals. We'll come and talk in a little bit later on about legacy transactions, but there are two big challenges facing us. First of all, how do we adjust to the new rates once we figure out what they are, and then secondly, how do we deal with the legacy deals? But we'll talk about that a little bit further on. So I'm going to stop there, and now I'm going to ask my colleague Alex Hunt to take over and talk about slide on page 4, headed Different Regional Approaches. And Alex is going to walk us through a quick summary of what's been going on in the 3 main zones in which AFME has been involved, actually AFME is mostly involved in the Eurozone and the UK. We work with our US colleagues on the US stuff. That's our friends at SIFMA. But I will hand over now to Alex, and he will walk us through that those sort of regional activities.
Yes, thank you, Richard. And so, as you mentioned, it really is a global issue. But there have been slightly differing approaches taken by the different jurisdictions to how they will transition from their current IBORs to alternative risk-free rates. So I'll start with the Eurozone. So currently, Euribor is the predominant IBOR in the Eurozone. It's produced by EMMI, and as we speak, it is undergoing a reform process to a hybrid methodology, which will attempt to use transactions data where possible, rather than quotes from panel banks. It's hoped that this new hybrid methodology will be compliant with the EU benchmarks regulation. However, it's not yet clear whether this will be the case. So Stevie later on will talk slightly more about the EU benchmarks regulation and how that ties in with the issues surrounding with the Euribor and the overnight euro rate, the ONIA. So she'll cover that in slightly more detail later. But last year, the European authorities, they set up a working group which was tasked with recommending alternative euro risk-free rates, and they held their first meeting in February of this year. So their job is to try and identify which rates could be used as a replacement for Euribor or even the ONIA if they're no longer compliant with the benchmarks regulation and can be used in the future. And the ECB at the same time is developing ESTER. ESTER is a new euro unsecured overnight interest rate. It's based on transactions reported by banks in compliance with the money market statistical reporting requirements. The plan is for ESTER to be officially published in the second half of 2019, and it could be recommended by the working group that I mentioned previously as the preferred euro risk-free rate. In the UK, Richard touched upon the developments in terms of LIBOR, so reformed SONIA was selected as the preferred sterling risk-free reference rate in April 2017. It's an overnight unsecured rate and was previously produced privately but is now administered by the Bank of England. The reformed part reflects a slight change, or a change to the methodology to make it more robust. And reformed SONIA was first published on 24th of April 2018. So SONIA was published previously, and a new reformed version was first published on 24th of April. In the US, I'll just touch upon that quickly. So the Alternative Reference Rates Committee selected SOFR as the preferred alternative rate to US dollar LIBOR in June 2017. Unlike the risk-free rate in Eurozone and the UK, SOFR is a secured rate, and it reflects transactions in the Treasury repo market. It was first published on the 3rd of April 2018. So in this respect, you can see the UK and the US are slightly more advanced in their selection and publishing of the risk-free rates than Eurozone. I think we will touch upon that slightly more in the coming slides. So I will hand back to Richard now.
Thank you, Alex. I'll just be very quick on slide 5 because I'm conscious I'm going a little bit over time. So this slide, page 5, just sets out a selection of some of the working groups that have been set up by the Bank of England and by the ECB to look at the various work streams that need attention to manage through this transition. You'll see there's a lot of different groups here. AFME is involved in several of them, along with lots of other trade associations, and it may well be that many members on the call are also engaged in some of this work. These groups are typically meeting quite regularly. They are advancing in their work, and they have specific items on their agenda. Development of term rates, impact for syndicated loans, thinking about what happens to legacy deals and contractual robustness, all this kind of stuff. So there is a lot of work going on. Hopefully many of the firms on the line here are already engaged in some of this work. So I will stop there, and now I will hand over to Ian from NatWest, who is going to talk to us a little bit about some of the practical issues arising for bonds, both new issues and legacy deals.
Thank you. So I'm going to mainly focus on sterling today, given it has an active derivative market, is probably the most advanced of the RFR jurisdictions, and is probably a good read across to the other jurisdictions. So I guess the question is, as Richard mentioned, we had the Andrew Bailey speech in July last year. Why haven't we seen a SONIA-linked, an RFR-linked bond yet? So I guess there are a few reasons for this. Firstly, a lot of the original RFR discussions were very derivative focused, and that market was deemed to be the most advanced, and therefore the other markets would follow. But there are also other issues around risk-free rates and the bond market. So going back to basics, I guess, what is the difference between a LIBOR swap and an RFR swap? So in this instance, SONIA. So a LIBOR swap or a LIBOR bond resets periodically. So whether that be monthly, quarterly, semi-annually, annually, it resets in advance and pays in arrears. So that is to say the reset is taken once at the start of the period. Therefore, you know your cash flow for the end of the period. A SONIA swap is reset daily and compounded. So that means for every single daily period, you sample SONIA and you compound it up and you only know your cash flow at the end. So that obviously creates issues for bond markets because that is a totally different calculation to what they're used to. I should also mention now with the Bank of England reform SONIA is actually published the next day. So that means for the last daily calculation, the daily period, you only know the SONIA rate on the actual day of settlement, which obviously causes problems. So what are the issues with using RFR within bond markets? As I mentioned, there's the daily reset element, which means the cash flows aren't known until the end of the period. So there are two issues there. The first of which is an operational point. So this is around settling the actual coupons. So there are many parties involved in that process. There are swap counterparties, calculation agents, paying agents, issuers, all of them speaking, agreeing the cash flows on the day of settlement is operationally difficult, if not impossible. The other issue is around forecasting. So a lot of, particularly on the corporate side, are used to forecasting their cash flows a long way in advance at the end of periods, so this creates a forecasting problem. Another point is around, which is more of a technical point, is around knowing what your accrued interest is. So if you settle a bond in the secondary markets on a T+2 basis, i.e. two days' time, with a LIBOR bond, you'll know you're accrued because you have your LIBOR set at the start of the period, you have your rate, and you can calculate the accrued based on a day count. With a daily reset rate, you won't know the next 2 days of resets at the point you trade the bond, so therefore you won't know you're accrued. So there's another operational problem around that. So this form of looking back and seeing what SONIA has been over that period has been deemed the backward-looking rate. So on the slide you can see here that the grey line is the historic reformed SONIA fixings over a period of 3 months, meaning a coupon from the 7th of March to the 7th of June, you would only know your cash flow on the 7th of June, i.e. that dot at the far end. So there's been a lot of discussion in the industry around kind of fixing this issue, and one of the solutions that's been discussed being a forward-looking rate, so forward-looking SONIA rate. So what is that? So essentially that is a rate that would be set at the start of the period, which would define the market's expectations of SONIA over that period. So if you look at the graph here, the green line here is the market's projection of SONIA as of the 7th of March using swap rates, and you would essentially take the average SONIA rate for that period, and on the 7th of March that would be known and you would know your cash flows. So how may that happen in reality? Well, there's going to be a consultation on this from the RFR working group, but essentially they'll look at different ways that the market-derived price can be found. Whether this could be executed transactions, at the London Clearing House or via the new SONIA futures, whether this could be from an order book or an auction process, things like an electronic platform, or via methods such as IS2FIX, where again banks submit a price. So this would essentially be the fixed rate on a SONIA swap of the same term. So for a 3-month forward-looking SONIA fixing, you'd be trying to derive the 3-month fixed rate for a SONIA swap. So at this point, if that was to be used within the bond market, there would be issues around conflicts of interest at this point. So the working group have said that they do not want active derivative markets in term SONIA fixings. The reason being that swap traders who are executing swaps, term swaps, would have exposure to a forward-looking SONIA rate, which they would also be able to influence via their short-term SONIA swaps. So there's obviously issues around a forward-looking structure and governance around that. So what is the market doing to look at this at the moment? Well, as I mentioned, there will be a consultation going out around forward-looking term fixings, how they may be derived and governed. As well, the market is looking into ways of issuing backward-looking SONIA bonds. So for instance, at the moment, we're looking into a backward-looking SONIA bond, which would have a reset lead, i.e. it would take the SONIA from a period of, for instance, 5 days in advance. And in that way, you would know your cash flows 5 business days before the end of the period, and you'd also be able to settle accrued. So I'll just move quickly onto the derivatives market, because obviously that's important when thinking about bonds and how you hedge them. What's going to happen to legacy deals on the derivative side? So at some point in the near future, ISDA will launch a consultation into how we derive the legacy LIBOR rates and what that will look like. It's likely to be a combination of a building block, something such as either the forward-looking fixing that I mentioned, or a backward-looking fixing, or possibly even just taking a spot rate, such as the overnight SONIA rate, and then adding some type of credit spread, which would compensate for the difference between LIBOR and SONIA. There are many different ways we could come up with a credit spread. A few different ways that have been discussed are around looking at the forward basis market, so looking at basis swaps over the next 50 years, and then implying the difference on an annual basis between SONIA and LIBOR, or I should say risk-free rates and LIBOR, over that period, and then applying that to the building block. Another method that's been discussed is looking at the historic mean average between the two. So going back over history and looking at the difference between, again, SONIA or risk-free rates and LIBOR, and deriving that difference and applying that to the building block. Another method would be to look at the spot fixing. So either the difference between 3-month LIBOR, for instance, and overnight SONIA, and applying that difference, or to imply some type of credit spread that could be dynamic. So the reason I mentioned the way the legacy derivative market might go is because you obviously need to consider this when thinking about legacy bonds transactions, particularly if you've hedged them with derivatives. So clearly, if derivatives go one direction and bonds go in a different direction, then you've got a problem in terms of economic loss or gain. For instance, if bonds were to go from a floating to a fixed rate, for instance, which we'll cover in the next section. So that's something to bear in mind when looking at legacy transactions, is how they're hedged and what would happen if the industry doesn't coordinate between those two processes. I think I'll hand over at this point.
Great, thank you, Ian. Claire, I think we can, I see there are some questions beginning to come in. I think it's fine to share those questions with everybody on the line to kind of maybe stimulate some more questions. But now I'm going to ask Jessica and Marcus from Freshfields to talk to us a little bit about the points on page 7. How is the market responding? And I think, Jessica, I think you were going to start.
Yes, thank you.
And then Marcus will pick up. Thank you.
Thank you, Richard. So for this section, we're going to focus on the possible impact of the discontinuation of LIBOR on the European bond markets and look at some of the measures being taken to address the issue there. Let's start with considering how European bond documents would typically work in the scenario where LIBOR rates were to be permanently discontinued and where no language specifically contemplating such a possibility had been included in the transaction documents. Most commonly, interest rates for floating rate bonds are calculated using a method known as screen rate determination. This requires the agent bank at the start of an interest period to look to a specific screen, such as the Reuters screen page LIBOR 1, to determine the LIBOR rate for that interest period. A margin would then be added to determine the interest rate. Fallback provisions are usually included to cater for the relevant screen rate being unavailable for short periods of time, but they were not designed to provide a solution for a permanent discontinuation of the relevant rate. Typically, if no rate is available on the relevant screen, then the agent bank is required to poll reference banks for quotes for the relevant rate. But in the context of a permanent discontinuation of LIBOR, it's unlikely that reference banks would provide such quotes. If no quotes can be obtained, then the ultimate fallback is to default to the most recent determinable rate. And in the context of a permanent discontinuation of LIBOR, that would effectively result in the reference rate becoming fixed for the continuing life of the bond. That's obviously unlikely to be a commercially acceptable outcome for all parties involved. A less commonly used alternative for determining interest rates is to refer to the 2006 ISDA definitions, a method known as ISDA determination. Under the ISDA definitions, the fallbacks currently stop at requiring quotes from reference banks, and they don't fall back to a previous rate, although ISDA is working on amending these definitions. Since Andrew Bailey's speech in July 2017, some attempts have been made to address the uncertainty around the future of LIBOR in the terms and conditions for floating rate bonds. At the moment, issuers are generally not including specific alternative reference rates as a fallback to LIBOR. For many of the reasons that Ian discussed, there are just too many uncertainties at the moment to be that specific. So therefore, the current solution is generally to increase the flexibility provided in the documentation to allow a switch from a LIBOR reference rate to an alternative risk-free rate at some point in the future when there is more certainty. Generally, one of two approaches is being taken to document this. One approach has been to include provisions which make it easier to amend transaction documents to effect a switch to an alternative reference rate at some point in the future, either by lowering required consent thresholds or completely removing any requirement for bondholder consent in specific scenarios. An example of this approach is the AFME model benchmark rate modification clause, which has been produced for use in securitisation transactions. This was developed from language that had been used in the securitisation market in the months immediately following Andrew Bailey's speech, which itself was based on AFME model language developed 5 years ago, but was adapted to address certain concerns that were raised by the investor community. The AFME clause allows for modifications to be made to transaction documents to effect a switch from LIBOR to an alternative risk-free rate without the need for a full consent solicitation exercise. Instead, the issuer is required to notify bondholders of proposed amendments, and so long as 10% or more of the bondholders do not object, then the modifications can be made without bondholder consent. This is known as a negative consent mechanic. To use this mechanic, the proposals must meet certain conditions which were agreed between AFME members from both the issuer and the investor communities. The trustee community also fed into that drafting. An alternative approach is to include a placeholder in the interest rate fallback provisions themselves, allowing for an alternative rate to be specified following a future trigger event, such as the discontinuation of LIBOR, without actually modifying the transaction documents. This approach has been seen in a more vanilla DCM space, where negative consent mechanics are not typically used. No market standard language has been agreed for this section of the market. However, a number of transactions are including a provision in interest rate fallbacks specifying that if certain benchmark events occur, for example, LIBOR is officially discontinued or it's made illegal to use LIBOR, then the issuer, with the help of an independent financial advisor, may determine a substitute rate. Typically, the language requires any rate which has been formally recommended by a relevant authority or working group to be used, or if no such recommendation has been made, then an alternative rate may be selected.
Great. Well, I'll take it on from there, Jess. Thank you. As you mentioned, for the market today, the main legal issues circle around uncertainty. I, at this point, do not know which new benchmark will emerge as the main one to be used to replace sterling and IBOR or Euribor. For sterling, as we've already discussed, SONIA is the front runner, but it's not known yet whether that's going to be a term rate SONIA will be developed at some point to a level of robustness and endorsement by regulators, which resulted in general adoption, or whether only a backward-looking SONIA will be adopted. And likewise, in continental Europe, consultations are underway, as we know, on what risk-free rate should be used. So against this backdrop, and leaving to one side for the moment existing legacy transactions, which contain only standard fallback provisions, as Jess has just described now, transaction participants face difficult choices as to what to include in their terms and conditions in order to enable an FRN to transition from LIBOR to whatever risk-free rate ultimately is adopted. This gives rise to a number of legal issues which are being talked about at the moment, which include disconnects between the rate to be used in FRNs and the rate to be used by associated hedging transactions, which could cause mismatches for both issuers and investors. This might just be a timing issue if the switchover ultimately is to the same risk-free rate in both elements of the transaction, but it could be a bigger issue if the benchmarks are actually different between the FRN and the associated hedging. Market participants may be subject to increased litigation risk if any switchover leaves investors feeling prejudiced by the switchover, or perhaps because the new bond sold today does not contain fallback provisions other than the defaulting to become a fixed rate bond if and when LIBOR is discontinued, which is obviously not what the relevant investors bargained for. Additionally, regulated entities who are leading transactions may be subject to increased regulatory risks, for example, under MiFID II product governance obligations or under FCA general principles if the FRN issued does not perform as originally sold or intended. LIBOR, in fact, may continue to exist, as Richard mentioned. It's not that it's going to be outlawed from 2021, but it seems to be sort of supported potentially, but it may continue to exist, but in some more unrepresentative form, on a basis which creates regulatory problems for regulated investors who continue to hold FRNs linked to LIBOR. Some of these issues can be mitigated, for example, by ensuring full disclosure in any bond prospectus regarding the nature of these risks and incorporating better fallback provisions such as those developed by AFME, which Jess just mentioned, to enable a switchover to be undertaken in a more benign way than under deals which do not have any such additional fallback provisions. But these steps will not eliminate risk, as they have been drafted at a time when the new benchmark provisions are not yet selected, and so there's just an element of uncertainty in the drafting. So market participants need to think very carefully about IBOR-linked FRN issuance at this point until a new agreed benchmark clearly emerges. Turning to legacy transactions, there's clearly a very significant issue for them. Much will depend on whether LIBOR continues to exist post-2021 or not. If it does, then transactions which set their rate by reference to LIBOR will continue to do so, even if LIBOR itself becomes unrepresentative and the market generally adopts some alternative benchmark such as SONIA. If LIBOR ceases to exist, and assuming reference banks decline to quote a rate, standard position, as mentioned earlier, will be for the bond to become a fixed rate bond. The only way to address this issue for legacy bonds, apart from refinancing the bond itself ahead of discontinuance, would be via a liability management exercise through which the issuer can seek the consent of holders to make a change to the conditions so as to reference the new benchmark and make appropriate consequential amendments. But I'm sure, as many members will know, such consent solicitation processes can be quite costly and protracted, and the outcome somewhat uncertain, especially if the economic value in the bonds before and after is different. That is bound to make the approach more challenging indeed. There's been some talk about possibly using the term LIBOR, but defining it in a way to mean the new risk-free rate benchmark, and so enable FRNs which do reference LIBOR to continue unamended. However, we think that given the various consequential changes to the conditions required to support a new benchmark such as backward-looking SONIA, this approach might not work. There have also been some mutterings by the market at least about whether there is a legislative solution so as to fix this problem. At the moment, this does not seem to be on the agenda, as even if it were, it may not deal with all the issues completely, given the lack of standardisation in how interest rates provisions are expressed in individual transactions. So all in all, we're in somewhat uncertain times with a known very significant issue for existing transactions which do not contain the new, more developed fallback provisions that we've already discussed. So now I'll hand back to you, Richard.
Thank you, Marcus. Thank you, Jessica. That's really helpful. I mean, there's obviously a lot of, as you say, a lot of legal uncertainty there that everybody's having to grapple with a little bit at the moment. For the last section of our presentation, and before we open for questions in sort of between 5 and 10 minutes, and I would encourage you all, please, to keep sending your questions in. We have had a few coming in, but please send some more. I'm going to hand over now to my colleague, Stevi Youssef, who is based in AFME's Brussels office, who is going to talk to us about the benchmark regulation. This is an initiative that has been going on for quite some years and is sort of parallel, but has very important implications for the wider move from IBORs to risk-free rates. But Stevi is very much the expert. So Stevi, I hand over the floor to you to take us through the key issues about the BMR.
Thank you very much, Richard. So indeed, I would like to say a few words on the benchmark regulation and its interaction with the transition from IBORs to risk-free rates. Perhaps by way of background and for members' information, I would like to remind that the European Commission had proposed a draft regulation on indices used as benchmarks in financial instruments and financial contracts back in September 2013 in the wake of the manipulation of LIBOR, Euribor and TIBOR in 2012. The European Parliament and the Council of the EU voted and approved the text of the benchmarks regulation, which entered into force on the 30th of June 2016. And it has now entered into application on the 1st January this year. The benchmark regulation has as objectives to first and foremost improve governance and controls over the benchmark process, improve the quality of input data and methodologies used by benchmark administrators, ensure that contributors to benchmarks and the data they provide are subject to adequate controls, and protect consumers and investors through greater transparency and adequate right of redress. ESMA, the European Securities and Markets Authority, is currently coordinating the supervision of benchmark administrators via national competent authorities, the so-called NCAs. The European Commission, to date, has listed as critical benchmarks LIBOR, Euribor, and EONIA. For critical benchmarks, a college of national supervisors, including ESMA, has been set up and is taking key supervisory decisions. Now, I would like to refer to the two most important articles within the benchmarks regulation that directly relate to the transition from IBORs to risk-free rates. The first article is Article 28.2, the so-called fallbacks article. This article stipulates that supervised entities other than benchmark administrators are required to have robust written plans for cessation or material changes of a benchmark, and also to reflect them in the contractual relationship with clients as of 1st January 2018. ESMA has further clarified in a Q&A that has been published a few months ago that these supervised entities are required to reflect such plans after 1st January 2018. However, in relation to contracts entered into prior to 1st January 2018 and still existing at that date, ESMA expects supervised entities other than administrators to amend them where practicable and on a best effort basis. The second most important article in the benchmarks regulation is Article 51, which stipulates the transitional provisions of the regulation. Article 51 basically says that benchmark users can continue to use existing benchmarks until the 1st January 2020. This, in practice, means that post 1st January 2020, benchmark users can only use benchmarks that are compliant with the benchmark regulation. There is a very important paragraph within that article, paragraph 4 of Article 51, that says that relevant national competent authorities are the ones in charge of deciding on providing grandfathering to non-compliant benchmarks for use in legacy contracts if two specific conditions are met. These conditions are first, the availability of alternative rates, and secondly, the inclusion of fallback rates in contracts and instruments referencing the benchmark. So I would now move on to slide number 9 in the presentation. As just mentioned, the European benchmark regulation prohibits the use of benchmarks in the EU unless their administrators have been authorized or registered by the relevant EU national competent authority. A 2-year transitional period during which EU and third country administrators are required to attain authorization or registration will indeed expire on the 1st of January 2020. As mentioned by Alex before, EMI is the European Money Markets Institute, an international non-for-profit association, which provides two indexes, Euribor, on the one hand, which is the money market reference rate for the euro, and EONIA, which is the effective overnight reference rate for the euro. Recently, EMI has stated that in relation to EONIA, it will not be possible for this critical benchmark to be reformed and thus authorized, and therefore it will not be available for the use in new contracts as from 1st January 2020. However, it may continue to be authorized for the use in legacy contracts by FSMA, which is the Belgian National Competent Authority in charge of the supervision for both EONIA and Euribor. On the other hand, EMI over the past few years has been undertaking reforms to ensure that Euribor and EONIA will be compliant with the benchmarks regulation. Euribor in particular is undergoing in-depth reforms of its methodology. EMI has been trying to put in practice a so-called hybrid methodology on the basis of both real transactions and quotes. The finalization of these reforms is required to demonstrate compliance with the benchmark regulation, but also to obtain authorization by the 31st of December 2019. However, the problem with the reformed Euribor is that the currently sustainability assessment is not expected to be published, even in a best-case scenario, before the first quarter of 2019, whereas the authorization by the FSMA is needed by the 1st January 2020. Therefore, this timing issue has been discussed, and also the consequences of the deadline of the 1st January 2020, should it not be met. This has been extensively discussed by the Euro risk-free rate working group. And during the last meeting of the working group on the 17th of May, members have agreed that the short time available for establishing solutions to the most difficult scenarios in case the deadlines are not met would actually make that task very challenging, if not impossible. Members have subsequently identified two possible mitigating measures to address the more difficult scenarios. On the one hand, they've identified as a possible mitigating measure the swift development of a derivative market based on the EONIA replacement rates, and as a second mitigating measure, a possible review of the deadline under the EU benchmark regulation to extend its transitional period. The latter has been also considered to be beneficial for third country administrators that are currently facing many difficulties to comply with the third country requirements under the benchmark regulation. However, important political and time constraints are attached to a possible extension of the transitional period. This is the reason why this particular issue will be further discussed at the next meeting of the Euro Working Group that will take place in Frankfurt on the 11th of July.
Great. Thank you, Stevie. That was a very, very comprehensive outline of the key issues under the BMR. And, you know, it's not just the fact that we have this 2021 deadline for LIBOR in the UK, but also the the 1st January 2020 deadline that you outlined, and the possible very close running up against that deadline is also something I think we would need to keep very much in mind. So thank you. Okay, we've got about 15 minutes to go, and we've been getting some questions in. Is there some way, Claire, I can see all the questions? Do I just need to scroll down? Okay. I think we'll start off with a question that came in, one of the first questions. It was a question about the EIB issuing a SONIA-based FRN. So is that something that anyone would like to talk about? I don't know how public this is.
I won't talk specifically about that transaction. I guess the one thing I mentioned earlier was around the market looking for new ways of launching backward-looking SONIA bonds, and how that might and what type of shape that might take. So we're clearly in an environment now where we don't have a forward-looking fixing, but we do have issues that we know that LIBOR may not exist at some point in the future. So clearly there is a will to come up with a new format for bonds that could exist at the moment and that could be issued, and that's something we'll probably see coming to the fore over the coming months.
Thank you, Ian. And I think the IB issued some time ago a SONIA-based bond, didn't they?
Yes, that's correct. I think it was back in 2010, but
yes,
a very different environment to the one we're in now.
Yeah, but it's interesting that example has been put forward in some of the working groups.
Indeed.
Working on this. Thank you. Somebody else has asked a question saying the following: presumably the market responds by anticipating more faith in the numbers being produced, and hence credibility improves. Isn't this the point? Well, I suppose the whole, as we try to explain, I think the whole drive towards moving away from IBORs to risk-free rates is to improve faith in the numbers, because I think the view is that there's diminishing faith in IBOR submissions for all the reasons we've talked about, absence of numbers of transactions. So I think it's not so much the point as perhaps the intention and the direction of travel. I don't know if anybody else around the table would like to comment further on that.
I mean, one of the interesting points about this is what will be happen to LIBOR in 2021. There's no talk yet of it being actively discontinued. And so you've got the benchmark. I still talking about trying to use it in some shape or form. Clearly, obviously, as we saw from the slide at the beginning, there are a lot of legacy transactions using LIBOR, and so there is the potential for it to continue to exist for a while afterwards. And it'll be interesting to see how the regulators react to that, because we'll be rather defeating the purpose of moving to risk-free rates if there is some sort of LIBOR still continuing and the transaction still able to to continue as a result.
Indeed, and actually somebody's just asked a question, is there any prospect that LIBOR will be retained in some shape or form despite the efforts to come up with a risk-free rate that works? Well, I suppose you should partly address that, Marcus. I suppose I'd perhaps add that from my experience in going to lots of meetings with regulators and policymakers around this, I think they very much want the industry to focus on finding solutions to the challenge and developing the new risk-free rates, rather than coming to the table with this is exaggerating to make the point, but with an attitude of, oh well, LIBOR will still stagger on, so we don't need to do much about it. I think if there's a feeling from the regulatory side of the table that that's what people are thinking, it's not generally very well received.
I think I was talking to some of the people at the AFME conference last week, a couple of weeks ago, and we were comparing and contrasting what happened in Switzerland with the SARON rate, and when sort of asking sort of why did that happen, how did that happen, I think the answer back was because there was a date certain when it had to happen.
Yes.
And so that made a big difference. People's minds were then focused that the cliff was coming and they had to be prepared. What I sort of think is different here is that isn't yet the position that we're facing with, certainly with LIBOR. And so there's perhaps more hesitancy around market participants grappling with the issue. And maybe at some point there will come a point where regulators have to put a hard deadline or some other sort of sticks, as it were, to ensure that the market does move to where it wants it to move.
Indeed, indeed. The questions are coming in thick and fast now. Blimey, I'm trying to figure them out. I mean, somebody's asked a question about Brexit. Are there any additional Brexit impacts outside the risk of potential fragmentation? Well, I'm not sure what we can say about that other than, piling benchmark or IBOR reform on top of Brexit is uncertainty upon uncertainty. Somebody in one of the meetings I went to did make the point that if there is a Brexit transition period which goes up to the end of 2021, I mean, that coincides neatly with the possible end of LIBOR. And do we really want to have two cliff edges, approaching at once? So I think that's probably all we can say about Brexit for now. Someone's asked about the slides. They will be available tomorrow, I think, on the AFME website, along with a recording of this this call. Sorry, I'm just scrolling through the questions here. Somebody's asked a very difficult question about, I think it's a very difficult question. Is there any clarity on the knock-on impact on hedge accounting? And to what extent have people started thinking on second, third order impact on trading book and banking book boundary issues, if any, under the FRTB? Who would like to answer that one? I think Philip, we'll have to follow up with you separately about that one. I'm sorry, it's a bit too. That's a bit above our pay grade just at the moment. Oh, here's an interesting question. Not that the previous one wasn't interesting, but here's a slightly more easier question to answer from Jonathan. AFME's work shows that the market aspects are well understood, addressed. Thank you very much for that. Which EU trade group is dealing with the retail, i.e. mortgage issues? How do the trades coordinate on this issue? I have a stab at trying to answer that sort of back to front. I think there is very good coordination amongst the trades on this. We're working very, very closely and cooperatively with our friends at ICMA and also at the LMA, and also with our friends and colleagues at SIFMA in the US and SIFMA AMG, which is the asset management group of SIFMA, basically an investor group. So I think there is quite good coordination. I think the point about retail is a very important one, and I think I might have said at the beginning, one of the easier things I think in the UK, and I'm happy to be corrected on this if I'm wrong, but my impression is that we have relatively little in the way of mortgage or consumer loans based on LIBOR. Obviously, we have a big wholesale loan market based on LIBOR. But that is not true in continental Europe. I know I was chatting to one bank the other day who pointed out to me they've got many, many billions of Euribor-based mortgages on their balance sheet. They have a sort of a technical fallback rate in them, but the fallback rate is actually quite above the current Euribor rate. So if there is a fallback that actually happens, the risk there is that you get, a lot of adverse publicity from all your retail customers. Why has my mortgage rate gone up from X to Y? So that's a big challenge. AFME doesn't cover retail, so I'm not quite sure who would be looking at that. It might be the EDF or someone. But if the person who asked that question would like to follow up with me after the call, I can dig a bit deeper there. It is a point that we have made to the various regulators that we speak to. I'm just scrolling a bit more. Let me see. Oh, here's a Here's a fairly technical question. How shall calculation agents under various documents like ISDA documentation, bond documentation, for example, be able to unilaterally adjust contract terms without contradicting the terms and conditions of the notes or running into transparency and disclosure problems? Well, yeah, I mean, I think that is a very difficult issue for calculation agents and trustees, isn't it, Marcus?
Certainly. I mean, unless the provisions and documents already allow for that, then they won't be able to do it. What we're seeing in some of the plain vanilla DCM transactions emerging now is the ability for the issuer alone, but in consultation with an independent advisor, whoever he or she is, to determine the successor rate and also to determine any sort of adjustment factor or whatever to try and make the subsequent rate, the successor rate, be economically equivalent to the LIBOR rate prior to the discontinuance. So, it'd be interesting to see sort of who emerges as the independent advisors willing to take on that role, given the potential for sort of risk and litigation, etc., if the outcomes are not what the investor community expected for that particular transaction.
Indeed, thank you. Here's a question on the BMR, and Stevie, you might want to have a go at answering this one. I'll read it out for you. The question is as follows. There needs to be coordination with ISDA in relation to the outcome of the BMR supplement to understand implications for asset swaps and liability swaps in securitizations and impact on benchmarks adopted to comply with the BMR. I don't know if you'd like to have a go at answering that, Stevie, or I don't know, or maybe it's one that we can follow up afterwards on. But what I think ISDA are working very much on some of these aspects, aren't they?
Yes, perhaps Richard, just to say on this that we are working closely with ISDA on these aspects, and we would be happy to follow up bilaterally.
Yeah. Okay. Here's a good one. Somebody's saying, and perhaps I could, you could have a go at answering this one, Ian. If you have a forward-looking rate, don't you still have the problem that it's relying on experience and judgment rather than just on observable traded levels?
It depends. It depends on how you derive that forward-looking rate. In the swaps market, there's something called the ISDA fix at the moment, whereby each counterparty submits the rates of the fixed rates of various tenor swaps at a certain point in the day, and that's based on where the market is at the time. So slightly more transaction based. So that's one method that could be used. There are other methods that would be actual transaction based. So you could take the traded levels of SONIA swaps, for example, in a 3-month period throughout the day that are traded via the London Clearing House, for instance, and you could use those to derive a term rate. Or you could use the live stream prices on various different electronic platforms, so using executable prices. So there is a way to derive a forward-looking rate that isn't judgment-based.
And we know that there's going to be a consultation paper on that, as you said, Ian.
Indeed.
Coming out in the coming weeks from the FCA, Bank of England. Okay,
it's 1 minute to 3, so I think we've got time for one last question. So this is a sort of an observation from someone saying there needs to be a coordinated approach from national working groups, given the large number of overlapping groups and subgroups, particularly in relation to the timing of the relevant initiatives. Yes, I think that's a fair comment. I would say in response to that I think there is a lot of effort being made to achieve that. It's not easy because of the sheer number of working groups, as you saw from the slide that we touched on earlier. There are lots of them, and we didn't even put on that slide the US ones. So it's one of the big challenges with this whole transition from IBOR is just the project management of it all. Yeah. I think it's fair to say that the regulators are very conscious of the need to coordinate internationally as much as they can. So it's not that the regulators are unaware of that. Having said that, we're already in a position where the US has gone down the route of a secured risk-free rate, SOFR, and in London, the Bank of England has decided to use SONIA, which is an unsecured rate. So there are issues there around what adjustments might you need to make for the difference in the credit spread and all this kind of stuff. So there's an awful lot to think about. So I think we'll have to leave it there for today. Sorry, we've gone a little bit over time. So thanks everybody for dialing in, and thank you in particular to our panelists. I'm sorry if I put some of you on the spot, and thank you all for asking so many questions. I think we don't normally get many questions, so this is really good. And also we had 200 people registering for this call, which is far more than we normally get, and I think we had about 100 people on actually showing up, which again is an all-time high for us. So just to sum up, I would just leave you with the thought that there are these important consultations coming up. Ian mentioned the one on term rates and this whole issue of forward-looking versus backward-looking term rates, and also the very important consultation from ISDA on derivatives. And lastly, something that we hope is going to be published fairly shortly. I mentioned briefly the ISDA, AFME, SIFMA, ICMA Global IBOR Transition Roadmap and Survey. The report, which is a summary of the results of the survey, we are hoping is going to be published in the next coming days. So please keep an eye out for that, because I think that will there'll be lots of issues of interest there. Good. All right. Well, thank you all. I think we have to wrap up now. As I said, the slides will be on the website tomorrow, and I think the recording will also be on the website tomorrow. So if any of your colleagues haven't been able to join and you'd like to send them a link to the recording, they can listen at their convenience. And of course, please do feel free to get in touch with any of us at AFME if you have any follow-on questions. So thank you very much, and have a good rest of the afternoon. Bye-bye.